On today's show, 4 questions plus a bonus round. Number 1, what the heck did J Powell just do to the market? Number 2, how scared should you be about what's happening in commercial real estate? Number 3, what happens when you invest at all-time highs? Number 4, how does a $6 billion company go bankrupt? Bonus, Super Bowl prop bets. Welcome to Dennis Money's 2 Cents, where we help Dennis navigate all the noise. I am Matt.
I'm Jake.
I'm Ryan.
And I'm Rabih.
Welcome, guys. Again, we have a bonus week, but the bonus question, because we have not 3 of us, but 4 of us for the second week in a row. Ryan, it is amazing to have you here.
Yes, thank you.
Thank you, Alex. Not in the Alex.
Alex Trebek. I don't know. It felt like that's
Trebek. Is that what I sound like right now?
No,
is that what I sound like?
That's what they say, and then they're like, "Thank you, Alex. Like, it's great to be here. Yeah. Thank you, Alex," or something like that.
So you're not currently in the flesh with us, but you are in Utah, and it feels really good to be in the same state as you right now.
We feel feeling the warmth. Yeah, thank you.
So we are going to start off with 2 big questions. These are so we're doing 4, and the reason being is Rabih got greedy. And he's like, I got 2 big things we got to talk about. So we'll give Rabih anything he wants. We'll give Rabih the whole dang show. So we're going to start with 2 big questions. Rabih, you didn't like the phrasing of this. I did it, to be sensationalistic here. I wanted to really get the people excited about what the heck did J Powell just do to the market. You wanted to correct me. Let's start here and tell me how I should have really phrased that question.
Well, actually, while I was thinking about it, I can give you an answer. J Powell reset expectations.
Okay, see, there you go.
But I'm hoping to give you some value today with me being greedy, giving 2 topics. And for the first one, on yesterday, Wednesday, the Federal Reserve had their first Federal Open Committee meeting for the year. And everyone was waiting for it because they are saying whether the Fed changed their opinion about how many rate cuts they're going to do, when they're going to do them, etc. And on top of answering these questions, which we're going to get to in a second, the Fed kind of gave a really good explanation to what they think happened in 2023. So first, what happened is that the market has been pricing in over like 5 to 6 rate cuts, according to the Fed Fund futures, the first one starting in March. And the Federal Reserve said, well, we've communicated around 3 cuts, and we're not even close to thinking about a cut in March. And, market did not like it. Most major indices dropped like 1.7% as he was speaking. Like, you can watch it live, which is the part where he set expectations. But I think the most important part was when they were asking him about the risks and when they think they should start cutting interest rates. And the previous conversation and the narrative has always been between soft landing and a hard recession, right? But now the risks that the Fed is saying is that they are trying to manage the risk of moving too soon in cutting interest rates or moving too late in cutting interest rates, which tells us that they are honing down to try to make this a good outcome or the best case outcome that they are doing. And in explanation to why they think this risk is what's important for them, he said, well, the economy in 2023 grew at 3.1% real terms, and inflation year over year dropped down to like 2.7, 2.9% on the core PCE, which are all good metrics. But he was like, although we care about those headline measures, let's actually zoom in. And as he was pointing out, goods inflation has been going down much faster. It's actually in disinflation compared to services inflation. And he said this might be related to supply improving. That's why goods inflation has been going down. And this might be temporary. So his reasoning for why the economy did well while inflation did not show up wasn't just because the American consumer consumed their way out of it completely, as we've been saying on this podcast. But also,
are you saying we're wrong?
I'm just saying we were misinformed.
Questionable, Rabih. Questionable.
But the point is, this was only part of the question, because if it was only the only factor that created strong economic growth was that the consumer consumed their way out of it, we should have seen also inflation next to those high GDP numbers, but we didn't. And the reason is because supply chain has been improving since the consequences of COVID and us, restructuring our global supply chains and, freight routes, etc. So because when supplies goes up, price levels go down, and when demand goes up, price levels go up. They kind of went up equally in a way that they kept price level unchanged or slightly going down, and this is how we saw inflation coming down. So this is their actual arguments. Like, we're not going to cut in March. It might be a little bit longer just because we don't think supply chains are going to keep improving at the pace that they are, which is very interesting because it broadens the conversation, and now we are really talking about like the health of the economy and not just inflation as a number. So it's kind of a regime shift, not regime shift in a sense, but a new narrative that the market can look up forward to, and I think that's valuable for asset prices going forward.
Can I ask you a question, Rabih? Obviously, you're not the Fed, and you're not, Chairman Powell. Why cut rates?
He's smarter.
Like, why even cut them if the economy, there's a lot of metrics saying the economy's in a pretty good spot right now. Stocks are doing great. Why do we even need to cut rates, right? Is there a problem to keeping them a little bit higher?
I love it that Jake doesn't know my next topic in details, but This is like a perfect segue to
That's what I wanted to do, was segue to your next topic.
Exactly.
That natural organic segue.
But the short answer is, we were running on a treadmill that was going 0.5, and every single month we're increasing it by another 0.5, 0.75, etc. We're running at a speed of 5.5. But how long can you keep running on a treadmill at speed 5.5 before you get
me or
tired?
Ryan? Who? Me or Ryan? Ryan could probably go longer than me. Just saying. So
I would like to see that live. I will bring 2 treadmills to the office.
We're not going there. No,
yeah,
proceed.
No. Ryan will beat me. To Jake's point though, so Rabih, you're just saying, it sounds like what you're saying is it's just preemptive. It's saying that before they're trying to thread the needle still, basically.
They're still trying to thread the needle. And to Jake's points, like, why cut it now? It's because it is in restrictive territory, and keeping it at these high of levels, the moment inflation starts coming down, this pushes real interest rates to go up, which naturally slows down the economy. So they need to move monetary policy from a restrictive stance to a more neutral stance, which means if inflation kind of disappeared, it doesn't hurt the economy just because interest rates are high.
But is the risk here, Rabih, you're saying if they drop them too quickly before they're fully confident that inflation is actually coming down, the risk there is they're going to have to reverse course, or it just has a bigger negative impact, and then it really gets kind of crazy at that point.
Exactly, because all the progress you've done in the last year and a half of raising interest rates, you won't get the whole benefit out of it, and you'll have to put some band-aids on top of the situation all over again.
Okay. And my other question, I'm curious, when we talk about the market pricing in 5 to 6 rate cuts, where did that come from? Like, Chairman Powell's coming out and being like, I never said that. Like, where is that coming from? Is that just the market just guessing? Is that analysts guessing? Is that insiders? What's happening there?
Exactly. So every time, the only way we interact with the market is by either buying or selling, right? And from that buy or sell decision, we get to a new price level. And each price level indicates different probabilities or different expectations. So when we are saying, here's what the market thinks, we are saying the traders and investors have driven the S&P 500 to a 48 level, price level. And the futures on the Fed fund rates are specifying these prices. These are equivalent to a cut every 3 months or a cut every month and a half. And this is how you extract this information. And it is valid. It's not like we are trying to guess. When the Fed fund futures follow a certain, slope, it means different interest rates at different times.
Got it.
Without trying to get too technical.
But he reset it now, like you said, the expectations. He's now saying probably 3 this year, right? And they're still in data gathering mode before they even begin to do it.
Exactly. And a function of that, some market prices adjusted immediately. And this is the market being efficient. And that slope of the forward Fed funds future curve actually adjusted to eliminate one or two of the curves of the cuts so far.
Got it. So I haven't looked today. That was yesterday, I believe you said, right? When you came up to me, and that's why I got the question, because you're like, look what Jay Powell just did to the market. Did the market kind of calm down a little bit today?
Yeah, it recovered a little bit more, but those are like micro movements of overreacting, underreacting.
Got it.
The second topic, and
yes,
it's
let's
like
get
what
to that.
would happen?
The Jake segue, yeah.
The Jake segue, like what would happen if we keep interest rates high for longer? This is actually slows down the economy, because any new borrowing that's gonna happen is gonna be happening at higher rates, which means it's a bigger expense or chunk on companies' income statements. So just by increasing interest rates, you are actually increasing expenses on companies. And by increasing expenses, you are reducing their profits. And if you are reducing their profits, they would want to do stuff to keep their profit rates healthy, right? This is the logic. So this doesn't happen like across all industries at the same time, but we've got a very fragile industry, which is the banking sector. And the banking sector, because it's very interconnected to all other sectors, whether it was tech, whether it was commercial real estate, whether it was healthcare, whenever something starts breaking, banks will feel it and banks will react quickly. And this second piece of news is actually a very recent development happening in the market. In the last 24 hours, regional banks, which are, the smaller banks, less than like 150 billion, this is much smaller for them. And
it's like Ryan's brokerage account. Yeah, Ryan's brokerage account. Yep.
Yeah.
So they've got on their books some commercial real estate holdings. And as we know, commercial real estate has been fluctuating and kind of struggling since COVID, because we all decided to work from home, and currently most of us still work hybrid. Companies are not finding enough of a reason to justify all the big rents in those skyscrapers in big cities. And as a real estate developer, they have to pay down those loans that they took to construct these buildings. And some of them are deciding not to pay back those loans and put them in foreclosure positions, which affects the bank that loaned the real estate developer to start with. So what's been happening is that we have a case that's very recent of the New York Community Bank, that its story is that in the last year and a half, it kind of more than doubled in price. One, because it acquired a different bank called Flagstar. And then back in March 2023, when we had like around 6 banks go bankrupt, including Silicon Valley Bank, this New York Community Bank decided to buy the book of Signature Bank, which also was one of the banks that went bankrupt. As a function of this bank growing too quickly, they got to a point where their book is full of assets that mismatch the risks, and with assets that are hurt if interest rates stay higher for longer, and with new regulatory requirements. So what they ended up doing was, during their earnings call yesterday, say that we're going to be cutting dividends to restructure our books, etc. And the market did not like it. That bank crashed 44% in the last 24 hours. On top of that, there's also a Japanese bank, regional bank, that's holding commercial real estate from Australia, also crashed around 36%. So most of the problems about the fragility of banks facing the high interest rate regime, and the fact that the higher interest rate regime might be longer than we expect. It's not going to start cutting in March. It might be until June or end of the year. It's putting a little bit of pressure on these banks. And we know that the banking sector is very interconnected and has this contagious effect. So does this raise the alarm? Is this something that everyone will be looking at in terms of risk management? Surely, but if we learned anything from the March 2023 episode, the market was able to absorb it and lessen the impact. So I hope, as regional banks try to, dust off the obstacles they're facing from higher interest rates currently, the industry as a whole is able to absorb it and keep us afloat.
So, Rabih, do you think that the aggressiveness and like the depth of that drop for both of those banks, did that have something to do with kind of the remnants of what happened with SVB back, like you said, in March 2023? Meaning people, were they reacting quicker because of like still being kind of scared of that situation? Or do you feel like it's not connected at all?
There are more unsimilarities than there are similarities. In the case of SVB Bank, it was the bank versus its own clients and their clients freaking out and doing a quick social media induced bank run, right?
Which was wild, by the way. It was wild.
Very wild. Whereas with this bank currently, their asset, as they accumulated new assets from acquiring different banks, they have like bonds on their portfolio with very long maturities that will require some different risk management. And some of that risk management requires good business environment. But the good business environment is not there simply because interest rates are high and it's hard for banks to conduct business at high interest rates. So this is putting some sticks in their wheels. It doesn't mean that this bank will go bankrupt. It might not, right? But it is stressing out their, income and their balance sheet, and the investors are reacting accordingly by either selling out or managing their own risks within their portfolio.
So the ultimate question here, to put a bow on this, how scared should we be about what's happening in commercial real estate, Rabih?
Maybe 2 over 10, 3 over 10.
Okay.
Simply
That's not bad. I'm not moving on. That's not even scary. Yeah.
We're moving on, but the banking sector is a very is a sector that allows contagion, and whenever something breaks, it kind of creates that domino effect. So it's always important to keep an eye on such stuff because you don't want it expanding.
Yeah, Jake, you got something. I can feel it.
Again, this may not correlate to almost last year this time with the Silicon Valley Bank and the bank collapses and people worried about bank stuff. I don't know. Maybe my overly simplistic view on it is the government regulates a lot of these banks. The government can literally print money anytime they want. They will bail out these banks anytime anything happens. Like I did a little history lesson on my blog that I do every Monday where it's like the number of people who have actually lost money due to their bank collapsing is zero. In like the past 100 years, like no one has ever actually lost a dime. And so that's kind of my thought on all this. Maybe again, overly simplistic, can't predict the future, but it's like, I just feel like worried on an individual level. I don't know if that's a real concern.
Well, and to that point, Jake, the recent precedent was set by the government that they weren't going to allow what happened in 0809, different situation, but similar, it rhymed, right? The history rhymed there. I think the government set the precedent in 2023 with SVB. They were not going to mess around. They were not going to allow that to get out of control. And so to that point, I think you're right. And that's probably, Rabih, what you're saying as well. It's like, it's fragile, but it's probably a 2 out of 10 fear right now. But still something for us to be thinking about. Okay, cool. Rabih, that was great. It was worth 2 questions.
I'm glad. Thank you.
Worth
2
2
cents,
questions.
2 questions. Yeah. Thank you.
2 cents, 2 questions for Rabih every time. If he wants it, Rabih, you get it.
You can have 4.
Okay, moving on. You can have the whole show. Okay, Jake, you had wanted to talk about what happens when you invest at all-time highs. This is a very appropriate topic because we are at all-time highs. Right?
Yeah, or just off with. We're talking about the S&P 500, right, Rabih? Are we just off? I think with this recent dip you talked about, we're kind of scrolling. But anyway,
we just hit him, right? We just hit him a couple of days ago.
Yes. January 29th or something? Yeah, we just hit new all-time highs in the S&P 500, which is great. I feel like this is what everyone wants, right? We like to see the stock market get into new all-time highs.
Get out.
But we've been waiting for this for 2-ish years, right? It's been a while, actually, since we hit new all-time highs. So I think it's noteworthy. But Matt, as you mentioned, inevitably, the funny thing about us humans and our investing psyche is we're so scared and we don't like the market when it's down. But right when it climbs back up and we get to these new all-time highs, our next thought is, man, should I be investing at all-time highs? That seems like a dumb idea to do. Why should I be doing this? And so we kind of just go with this cycle of we don't like the market when it's down. We don't like it when it's up. And so just as a friendly reminder, just a couple data points of like, okay, is now a good time to invest? Should you invest at new all-time highs? Peter Mallouk. What is Peter Mallouk's business that he owns?
Creative planning.
Anyway, financial plan again. All of it. Yeah. All of it.
Everything.
He had a tweet recently. Yeah, which is actually from JP Morgan, I think is where the data is from. We're just talking about, he has a graph here that shows, okay, what happens, like what are the projections for when you invest at all-time highs or when you invest at any other day in the market, right? Kind of what is your 1 year, 2 year, 5 year outlook, right? In every instance, every 1 year, 2 years, and 5 years out, historically speaking, you actually have made a higher return investing at all-time highs than at any other day in the market. Which
so not a bad time to invest.
Not a bad time. That might seem counterintuitive, but I think we've talked about this on this podcast many times before, which is that market returns happen in clumps, right? Kind of the reasoning behind this is like one all-time high tends to lead to more all-time highs, right? All-time highs happen in bunches. And so it's like when you're investing at these points, it's usually like you're catching the momentum of the market and going up typically. And so, yeah, just kind of, I just wanted to calm if you're out there, thinking, that if we correctly categorized your thinking of, oh gosh, the market's getting high, maybe we shouldn't be investing as much, let's look at other things, I would say do not worry. This is actually a good thing for your portfolio.
And Jake, you had another little kind of layer to this. You were talking about with rate cuts during years of all-time highs or periods of all-time highs. Yeah. Do you want to hit that too?
So if we want to get more specific about the current environment we're in, this goes to what Rabih was just probably talking about. Ryan Dietrich on Twitter, this was a post from him. Anyway, he went back to 1980 and he's like, he found 20 times in the past, 40 years, where the S&P 500 hit all-time highs while simultaneously the Fed was cutting rates, right? Going back to what we were talking about. And in each of these 20 times, the S&P 500 finished on a positive note a year from that point. Every time. It's like 100% success rate in all these 20 times. So that's kind of the environment we're in now. Again, this is not predictive. This next year could be the one time that fails. However,
timestamp.
It bodes well. Again, I'm here. I feel like my job here is just to be the optimist, maybe a little bit, and this just shows optimism for the market. Things look pretty good for your portfolio.
Well, I feel a little bit. Oh, go ahead, Ryan. Go ahead.
Oh, sorry. I'm just thinking about like the argument against investing at all-time highs is something I've heard about since I started this job, and if you were to ask anyone, like, would you have liked to invest your money in 2007 or 8 or 10 or 12 or 15 or 18, like any time period in the past, like everyone would say yes.
Perfect time to lose Ryan, isn't it?
Oh, boy.
Or I was wondering if he was just waiting for us to answer.
Oh, there he is.
Yeah. So anyone would want to go back in time to invest earlier. Anybody would. But along all of those years, it was always an argument about all-time highs. It was always a fear about all-time highs. But it goes on, and then you're like, I wish I would have invested 5 years ago or 10 years ago or 15 years ago. Even that was an all-time high too. Like that fear is always there, and it always keeps going, and it always will be. But yeah, Jake, that proves it.
Today's all-time high is tomorrow's low, right? That's kind of like next year's low or 5 years from now's low, right? That's kind of a good way to think about it.
Yep. Yeah, I mean, this is what we talk about all the time, right? Is again, it's so simple, but the all-time high means nothing, and if anything, it means it's counterintuitive to what you think. You think again, like Jake, to your point, you think because we're at all-time highs, it must go down. It's like actually, no, it actually just history shows it just keeps going. It just keeps going.
Yep.
But Jake, what I was going to say is, I feel a little bit like you're jinxing it. I feel a little bit like. The kicker getting up to kick it, and the announcer's like, he's 25 of 25 this year.
I just gave the 20 of 20. Yeah, so we'll have a podcast a year from now and be like 20 of 21. That last year where the market's actually down.
Freaking Jake. Yeah. So, okay. Yeah. Well, that's good news. That is good news overall. The probabilities show that it is still a good time to invest. Okay. Ryan, on to your story. Here's the question. How does a $6 billion company go bankrupt?
Yeah, so assuming my hotel internet lets me keep talking and talking to you guys here. Has any of you guys ever done your DNA testing with 23andMe or any of these companies?
I have not. I've heard some crazy stories of 23andMe, though. Some crazy stories.
Too. The history of it is it's a really cool technology. It's been a really cool service. That came out a while ago. It went public a few years ago to provide this kind of like feedback, and it was a huge hit. It quickly became obvious that kind of data would be so powerful as a drug maker, as a drug company, as a developer, because of having all this genetic information, right? That kind of started bothering people, but at its peak, this was a $6 billion company. It went public a few years ago, I think 2020 actually. Since then, they've had gigantic data breaches, which they didn't disclose or really recognize, or pretended they didn't recognize for like 5-6 months, where incredible amounts of personal private data have been stolen. And since then, yeah, the shares are now below $1. They're as of yesterday under threat from being delisted from the NASDAQ, and all sources of their funding and money point to almost running out. The CEO, she's still continuing to like march on with, this company could provide something to a drug company, information and data to a drug company we've never had before, which, is very interesting. But it's gone from like the tippy top to the bottom. For me, this is just another example of how hard stock picking is. It doesn't matter how incredible or innovative or different or new or exciting anything that the company is offering or doing. You never know what will take down the greatest, biggest company and how fast it'll happen. And it's just another tale of how hard it is to choose which companies are going to be the big ones and which ones are going to fail.
Yeah, it's so true. Just the power of, and the reason reinforces why we talk about diversification so much. And to your point, Ryan, you never know when it's going to be a NVIDIA, right? Meaning the NVIDIA of 2022 that drops by 80% in 1 year and then has done what Rabih? It's now 180% since or something.
Well, 2023 was insane. 2023 was like 250% or something.
Yeah, even more. So, but so to that point though, you never know. Is it a NVIDIA or is it a 23andMe that's literally going bankrupt?
Can I redo my article headline? I want this based on the volatility, right? I want this to be 23 and we. 23 and we. That's what I want. That's what I want this to be. We can do that.
We were racking our brains to start this before we hopped on of like what could we use as a pun for that question, and we were just, our brains are dead.
23 and
so we couldn't.
Yeah.
So 23 and we. I like that. Rabih, any thoughts on this, or just kind of reinforcing what we just said?
Reinforcing it, and like the fail of 23andMe does not mean that the initial perception about what the future is going to look like and how big genetic information is going to be impactful to the healthcare sector. The fact that the company failed doesn't mean that humanity is not advancing in that direction. It's just you don't know who's going to be the Olympic runner with the torch, right? That's why you have to be diversified, although you agree on a certain vision of the future.
Yeah, it's a good point, Rabih. This made me think of the .com era, the .com craze, right in the 90s. It's like both things can be true, which is that changed the world forever. The internet changed the world forever. That technology carried on, and there's businesses like Amazon that came out of that literally have changed the world and gone on to be one of the biggest companies to ever exist, along with Google, and others. But how many compared to those, how many thousands of companies were created, like, I don't know, diapers.com or whatever, that went under. So to your point, it still remains that company can be completely bankrupt, but the technology and the change it's going to make to society remains and moves forward. So that's a really good point. But bottom line is, stock picking is really hard. Please don't do it. Just please don't. Like, you're not going to succeed. I'm sorry, but you won't. Okay. Those were the 4 questions with the bonus. We have a bonus now. We wanted to talk Super Bowl coming up here in a couple of weeks. It's basically a national holiday. Ryan, I know how excited you are. You are so giddy about this. So giddy about this sports.
Can I give a hot take? Let me give a Super Bowl hot take. I think I like the Super Bowl more than Thanksgiving as a holiday.
Ooh, that is a hot take.
My main reason being is I actually
so mad right now.
I think the food at Super Bowl parties is better than the food at Thanksgiving is my hot take.
How dare you?
Rob's so mad right now.
I'm fine switching out turkey and stuffing and rolls for wings and chips and dip and all that kind of stuff. I kind of just prefer a Super Bowl platter more than a Thanksgiving platter.
I love the Super Bowl. It truly, to me, should be a national holiday. I love it so much.
Monday off would be awesome. Yeah, we just take the Monday off after every Super Bowl. We should implement that.
Oh, That'd be great. Dropping a hint? You just dropping something to me? Like, hey, Matt, why don't we do this? I like that. So it's pretty dang close for me. Like, I truly look at the Super Bowl as a holiday for me. Like, personally,
I love
it.
Family, the whole thing.
So fun. And
This is
especially
the
this
most
year.
American conversation I've ever heard.
Well, you know what, Robbie? We're in America. Okay.
You're American now.
You know what the best?
Actually,
You know what the best? Yeah, you're American, Robbie.
You're American
You can come over to
now.
my house. We'll watch it. Yeah. The best part about this year, and we're not going to go into this. I'm just going to make a quick comment. The conspiracy theories around this Super Bowl, I'm here for it. It is hilarious. It is so fun. I've grabbed my popcorn. I'm just watching from the sideline, and it's fun. It is really fun. It's making it extra interesting. Okay, so real quick, we're going to hit predictions for the game. Robbie, who you got? And then we're going to talk just quickly. We're going to hit some crazy prop bets. I think it'll be interesting. But Robbie, who do you got for the game?
Is that a trick question? I don't even know who's playing in the final.
In the final. Okay, never mind. And Ryan's not going to know either. Maybe we forego the predictions.
I
Ryan,
got a
who do you
prediction.
have?
Taylor's already won. So that's it.
You're going for Taylor's team no matter what.
Taylor already won.
Robbie,
Yeah.
Robbie, just so you know, it is the San Francisco 49ers versus the Kansas City Chiefs. Taylor Swift's Chiefs versus the Niners.
Yeah.
What's their historical record? How many Super Bowls does each team have?
Robbie's going to go run some analysis. Some
regression. I'm running regression.
I think the Niners have five or six. This would be 6.
Yep.
The Chiefs, is it just recently? Patrick Mahomes is the Chiefs quarterback. He's won 2 out of the last 4.
So to give you some context, though,
momentum.
This would be Patrick Mahomes says this is his 5th Super Bowl, like going to it, right?
This is his 4th. He's lost 1 before.
4th. Okay.
He's won 2, lost 1. Mm-hmm.
Yeah. So this is his 5th, which is pretty wild. 5 of 6 years. Anyway, there you go, Robbie. Robbie, we'll come back to you later after you've run your regression analysis. Jake, I know you got a take on this.
Yeah, I think the Chiefs are going to win. Not because of Taylor Swift, but if you want to use that as your reason, sure. I am a
conspiracy.
I know Patrick Mahomes. He's getting to that point where he's getting so good that we hate him now, right? And people are turning on him.
Yep. He's villain
status. It is hard to bet against that guy. I mean, he's pretty dang good.
He is very good. Okay, so we just want to finish this up. Thought it would get kind of fun. Jake, just throw at us. So first of all, what is a prop bet? And then maybe let's just throw out some – Ryan's throwing up on the screen, Taylor Swift flexing. Ryan might be a bigger Swiftie fan than anyone in the office, which is actually saying something. Jake, hit us with what is a prop bet? And then let's just go through maybe a couple of prop bets that are kind of crazy for this game.
We'll do this quick. Yeah, for those who don't know sport, this is kind of a sports gambling thing. The Super Bowl is the #1 most bet sporting event in the world, if you're wondering. So like the most money is wagered on Super Bowl stuff than kind of any other event. So it's a big deal for these gambling places, right? We're probably going to see at the Super Bowl every sporting event you watch, you see ads for gambling sites all the time now. But anyway, yeah, there are literally thousands of bets you can bet on this game. Like every angle, you can dissect this any way you want. It's crazy, but they really have out there bets. Like for example, one of them is you can pick what color the Gatorade is going to be that's going to be poured on the coach is a popular betting trope, right? So it's like purple Gatorade. Are we going yellow? Is it red?
Orange,
orange. That's a very popular one that people get into. Another one is like how long will the national anthem be? Is a very popular bet. Is Reba McEntire.
Is it like an over-under?
Over-under, yeah. So Reba McEntire is singing. The line is at 1 minute and 28 seconds. So what you bet is you say, is it going to be less than 1 minute and 28 seconds or longer than 1 minute and 28 seconds? And people will go into they try and find old footage of her singing and all this crazy stuff, right, to figure out what's going to happen. There's a first ad bet that I saw. Like, what will the first ad be? It's between Coors Light and Uber Eats.
Okay.
I don't know. You can bet on that there.
Yeah.
We talked about this the other day. You can actually bet what the price of Bitcoin is going to do during the game of the Super Bowl. Will it go up or will it go down?
Robbie's hopping on that one.
There is will a player propose to his girlfriend after the game bet as well that you can
That's going to be, the odds have got to be pretty good on that one. That's going to happen.
I think it's like 2-1. So if you bet yes, you get 2-1. Whatever you put in is kind of yes, that'll happen. Taylor Swift, Travis Kelce.
What
Ryan?
if? There couldn't be a bigger proposal in the history of humankind. In that moment, if it happened in that moment, like we end human civilization after it just ends. That's it.
Just everyone just dies of happiness.
Can I ask you a question real fast? As a non-better, because I'm not smart enough to do this stuff. Are people just desperate to like bet? Do people just are just desperate to gamble? Like I'm
And he
just so
cut out.
confused by it's
But he might be
crazy.
coming. I'm guessing, like, what is he saying? Desperate to feel something? Yeah. He's funny that he said, like, because I'm not smart enough to do it. You're actually smart. You're the smart person for not doing it, right? Is actually the correct thing there.
But here's the lesson here. I was going to say, truly, and Rabih has never hated a conversation more than this one right here. Here's the lesson, I think, truly, because I think this stuff's kind of fun. I don't do it. I don't bet on any of this stuff, but I think it's actually kind of fun. Jake, you bet on a couple of things just for fun, right?
Oh yeah.
Here's my take. You should do it. Like if you have any inkling or any itch to do this, you're better off, in my opinion, having fun with this as opposed to betting on your investments and going out and buying stocks like 23andMe and actually treating that like gambling, right? Have a system around investing. That should be boring. And then take a few $100, take $1,000, depending on your situation, and go do some prop bets in the Super Bowl and have some fun with it. At least treat it like it actually is, which is gambling, and don't treat your investments like that.
So many people we know gamble. They call it investing, but they're actually gambling, right? It's like at least the people doing sports betting, I think they know. I mean, some might not know, but they know that it's like this is pure gambling. You know, we have no clue what's going to happen.
Rabih does not agree with that statement. Rabih, hit us with why I'm wrong, please.
I'm gonna hit you with a behavioral answer. Someone who bets on sports games has the same behavior of betting on stock market. You can't be a bettor on one side and not a bettor on the other. So I think don't bet and let it be very boring.
See, okay, I'm with you. Rabih and I are gonna have our first argument openly as a couple on this show. I agree with you, Rabih. I actually agree that I think you have a personality of doing that, right? But I'm going to take Jake as an example. Jake has a better personality, right? Jake, right? You've got a personality that enjoys the thrill of gambling or betting, right?
Just because, I mean, I love sports, and so wagering on them, it increases the juice, right? You get a little invested in the game. It's fun.
Yeah. So I think, in my opinion, I'm with you, Rabih. I'm totally with you. That's a personality thing. I am not like that even a little bit. Does not interest me at all. I don't put any money in any of this stuff. And I don't treat my investments like that either. It's just not my personality. However, I think there's a huge difference in behavior when you're repressing that across the board and you just say, don't do it. Don't do it across the board versus saying, okay, this is something I actually like to do. And I'm going to find a quote unquote healthy outlet for it and have some fun. And so and maybe put some rules around it, but do it in an outlet like this gambling on the Super Bowl. So and that way I don't feel as much of a need or an urge to do it with my investments.
It's funny. Speaking for my case, you will not find a person who is more passive in their investments than I am. Like I could not tell you the balance of my investment accounts at the moment.
But you are gambling, not like aggressively, but you're putting money in on sports every month.
This is the fun thing. Yeah, this again, I like to do sports occasionally. Again, the dollar amount is so small that if I win, it doesn't matter. If I lose, it doesn't matter. It's just the pride of knowing I guessed this and I won it, right? That's the thrill. It's not even the dollar amount. It's like, I guess that someone's going to propose to their girlfriend correctly at the Super Bowl. And when that happens, you're just like, yes, I'm a future predictor, right? It's just that thrill of like, I knew it, is what you're going for.
For sure. Rabih, the bottom line is you're probably right. I'm never going to tell you you're wrong ever. So, but again, I think it's kind of fun. So any other final thoughts on any of this stuff?
Yes. Saying Rabih is probably right is a good bet.
Yeah. That is true. Okay. Guys, final plug. Again, as always, please check out DennisMoneySummit.com. Our Dennis Money Summit coming up in June, Park City, Utah. We won't go too long on this. You hear this every show. But we just did a presentation today, Ryan and I. We're recording this currently on Thursday. This will come out on Monday. We were at the UDA this week. We talked about the Dennis Money Summit, had several people come up and say they were signing up and super excited. The momentum is building. We're so excited about this. So go check it out, DennisMoneySummit.com. We'd love to see you there. Love to have you come hang out with us. Love to come argue with us about should you be betting on Super Bowl or should you not. We would love it. So, okay, guys, that was our 2 cents. Ryan, there's only one thing left to do. That is go forth, live your rich life. Bye-bye now.